Okay, so let's begin. Thank you everybody for joining today and welcome to this webinar where we're going to talk about how you can go about improving your trading results by utilizing a trading grid. Now, I'll tell you a little story to start with. So back way back when I first kind of got into this, I started off by looking at, actually it was news trading, it was arbitrage trading at the time. This is back in the Wild West of 2005 and, we had some shady brokers here and there, but there were also some really good opportunities out there trading the news. And I made a lot of money during that time. But then what happened was I got burnt very quickly because I didn't really understand what it was I was doing when I first started out. And then I got introduced to grid trading. And to be honest with you, although some of my trading has evolved over the time and I've found different strategies and different ways of expressing my view in the market, utilizing the grid, especially in the early days, was a way that was able to get me to a point of profitability very quickly because it allowed me to remove a lot of the subjectivity from my trading. So, when you're looking at technical analysis and you're trying to find those patterns and it's always like, oh, well, is this the right one? Is this the wrong one? Well, utilizing a trading grid, what it allowed me to do was kind of, yes, I would still have a strategy for getting into and out of the markets, but actually it put me in a position where the entries, the technical aspect of my trading wasn't as important. It was more to do with my management of my positions once I was in the market. And again, it wasn't to do with patterns or anything like that. So it took away that pressure from trying to find the exact perfect opportunity, which allowed me in the end to actually be, very profitable. And then I went on from there to start a fund with my brother, and we've been very successful ever since. But the point I'm trying to make here is what I'm about to show you here is one of the things that really helped us to get started in this business and was one of the first strategies that we ever utilized that took us to profitability and consistent profitability, not that sort of lucky profitability where you have a few trades here and there, you don't really know what you're doing, but you manage to make some money all the same. This was a systematic approach to trading that, as I said, removed the subjectivity, removed a lot of that decision making there, and just left us to saying, well, as long as you can manage your trade correctly, then the odds are that you're going to come out ahead of the game. And sure enough, we were able to make money, and we then parlayed that success into starting a fund. And here we are today. So I hope you're all really excited to learn this. I'm certainly very excited to teach you about it. So here's a question for you all. Who's been in this position? You've been in the markets, you're looking for which direction to trade in. You see an opportunity at that green sort of circle over here. The market has been moving up, it's been trending upwards. You say, okay, now's my time to get involved in the trade. You take the trade, then the market goes away and it stops you out. So maybe you have your stop below the low of this swing here. The market stops you out. You're not in the trade, and then suddenly the market roars off in the direction of your trade. Who here has been in that situation before? Just type a yes or a no into the chat box. Have you experienced that? You found an opportunity, you've taken it, it's taken you out, and then suddenly the market roars off in the direction that you that you wanted to be in. It's frustrating, right? Well, the good news is that that isn't going to be an issue for you anymore. Okay, so as the market moves up and moves down, there are so many opportunities to make money in the markets. The difficulty that most retail traders face is that they don't know how to identify it before it moves. But the thing here is that actually you don't need to be able to identify it because I'm going to give you a framework that's going to allow you to take a trade from more or less anywhere on the charts, and you'll still be able to get out having made a profit, even if you're wrong on the initial direction of the trade. How does that sound to you all? Sound good? So let's talk about the Forex markets, and let's talk about what the brokers would have you believe. And that is that the Forex markets, they trend more than any other market. The change of direction has got me a few. Exactly, Mohammed. So as I was saying, like the party line is that the Forex markets, they trend more than other markets. That's why what the appeal is. You can get there, you can pretty much take a position anywhere and you'll come out ahead of the game if you're using technical analysis. And that's not quite the truth. Okay, because actually, whilst there's volatility in the FX markets, they don't actually trend like other markets. In fact, data shows the Forex markets move less in percentage terms than other markets. Therefore, we need to build an approach that not only accepts this fact, but actually embraces it. And to back this up with information, we did a study into some of the major markets. We looked at the currency markets, we looked at the dollar index, we looked at the equity markets, the commodity markets. And what we found wasn't actually a surprise to us, but it might be a surprise to you, and it's going to help to illustrate our view that the Forex markets don't trend. So the chart that I want you to really pay attention to is this one down here where it says cross-asset trend analysis. And what we're interested in here is if you see the dollar index, all right, the blue line is 1 month, the orange line is 3 months, the gray line is 6 months, the yellow line is 1 year, and then the blue one, again, is 5 years. Now, what I want you to pay attention to is, first of all, look at the currencies. Do you see how on a month-by-month basis or general move basis, they don't really move more than 10 to 20%. You've got the dollar index here, right? It got up to 10%, then retrace. Aussie dollar moved up 10%, then retrace. Euro dollar, same sort of thing. And then when we come to things like the S&P, we get, some over a 1, 3, 6 month period, you get some nice appreciations. But then when you look at it 5 years out, it's appreciated 100%. What about gold? Same sort of things, moved up nearly 60%. Oil dropped back a little bit. It's a little bit more cyclical in nature, so kind of similar to FX in that respect. But then we go and we take a look at some stocks. We've got AMD, we've got Apple over here. Look at how it does over a 5-year period. Now, the crucial part about the FX markets is look at what happens. So over a 1-year period, you're going to see an appreciation, but over a 5-year period, more often than not, you see the markets retrace. Now, why is this? Well, the Forex markets are cyclical in nature, okay? And the reason that they're cyclical in nature is that you've got basically you're trading one economy against another. So for a sustained trend, okay, to emerge in a currency, what you would need is you'd need an imbalance of those two economies, and you would need it over a sustained period of time. So essentially you would need, Europe to almost implode whilst the US prospers, okay? And you'd need that to happen over 3, 4, 5, 10 years. Now that doesn't happen because, each region, each country, they have central banks and they've got various tools at their disposal to help stimulate their economy, okay, or fight inflation, which is what we're looking at right now. But essentially, the markets move through cycles. And as they move through cycles, certain currencies become more appealing than others. And then, other periods of time, those currencies that weren't appealing before will then be appealing again. And that's why you get these cycles. So the Forex markets, they don't trend forever. Yes, they trend quite nicely from time to time. But generally speaking, if you pull up a chart of the euro dollar and you pull up a chart of the NASDAQ or the S&P or a stock, for example, then you're going to see that they're not even comparable. In fact, there's a statistic in the stock market that says that if you take a position anywhere and close your eyes, over a 5-year period, you've got a 96% chance of being profitable. Imagine that. Now, we're not saying how profitable it will be, and there may be some swings against you, but essentially, particularly in the US stock markets, the markets just tend to go up. The FX markets, they don't do the same thing. So then you'll say to yourself, well, then what's the benefit of trading FX? I'll just go and trade stocks. Well, the FX markets has a lot of benefits to it. There's a lower barrier to entry for one. It's a 24-hour market, so you can always be in there. You can manage your positions no matter where you are in the wilderness, and it's more liquid as well. Okay, and once you understand what I'm about to show you, it's actually easier to trade at the same time. So what you need for this, and to be able to be successful, is you need to have a complete paradigm shift. Most retail traders lose money because their approach to the market sets them up for failure. In order to be successful in the long run, you have to change the way that you approach your trading. That's what I'm going to teach you today. And the good news is that this isn't something, you aren't my guinea pigs, okay? So we've taught many people this before. And in fact, when we first thought about introducing this to the world, we decided to take on a group of beta testers to test the strategy to make sure that it wasn't just us that could make money from it. Because it's all well and good being somebody that can make money from a strategy if you've had a lot of experience in the industry, which we've had. Okay, but then being able to just give it to anybody else, for example, and making sure that they can make money, that's obviously very important to us as educators. Now, the thing here that was really amazing was that pretty much every single person came back and they made money over this. And they made a monthly gain of around 6%, which annualized is 72%, trading only small position sizes. So it's very, very effective what I'm going to show you here. And Alan, one of our traders, said this is the safest trading system he's ever come across. Trading always involves risk, but the system uses natural harmonic movement and price action to capture profit. Essentially, what he's saying here is that this approach to trading allows you to trade with a low level of risk and a high level of confidence. And he was able to bank 650 pips in the period of time that he was testing the system, which amounted to 6%. Okay, so let's jump into the framework. So the framework itself. All right, what you need to do to be successful, you need a way of determining the direction of the markets. You have to have a way of valuing the asset that you're trading. Then you need easy to understand entry rules and a well-structured trade management system. Now, I'm going to talk to you a little bit about all of these four concepts, but what we're going to focus on are point 2 and point 4, okay? Because the process for determining a direction, there are many different ways that you can do that. And actually what I'm going to show is even if you get the direction wrong, there's still an opportunity for you to be able to make money here, okay? And then in terms of the entry rules, well, once you've got this framework, as I said to you earlier, entries aren't everything. So you can just use your favorite strategy and you'll be able to make money with this approach. So the first thing, determine the direction. Okay, once we determine the direction of the market, it makes everything a lot easier. Okay, establishing a directional bias, whether you be trading this way or any other way, is probably one of the core components of success, because not that it's the sort of like the magic beans or anything like that, but what establishing a directional bias allows you to do is it allows you to exercise a little bit of discipline into your trading. And because you're utilizing a directional bias, it has the inherent benefit of keeping you out of a number of losing trades that you would have taken otherwise. Okay. Now, there are various different ways that you can determine a directional bias. You can use fundamental analysis. You can use technical analysis. You could use sentiment analysis. But the key is having an objective process that's repeatable. Now, what I like to use interest rate differentials because I've found over time there is a correlation there. Now, it doesn't have to be perfect. It just has to give me, a view of the markets for the next, say, 3, 6, 12 months. And that's what that allows me to do. But if you wanted to use swing highs and swing lows, if you wanted to use moving averages to be able to determine your direction, that's absolutely fine too, as long as you have a mechanism for deciding which way is it that you want to trade. Now, the next part is you have to be able to value the assets. In order to make money, we must have an understanding of where the currency pair is, okay, in relation to where it could be. Is it cheap or is it expensive? When you're looking to buy a house, okay, and this is actually quite similar to what we're going to do here. Not that we're buying houses, but the view that we take, right? So when you're looking to buy a house, you're not looking to make money tomorrow. Okay, so you're not thinking, okay, if I buy it today, I can sell it tomorrow for a little bit of extra money. What you're doing is you're saying, I'm going to buy a house now. I want to live in it. I like the look of it. It's great. And it's going to go up in value over, the next 1, 2, 3 years. And when we're trading this approach, that's kind of the view that you want to be taking, that you want to have with your trading. You want to say, well, you know what? I'm taking a trade right now. Is it going to go up tomorrow? I don't know. Is it going to go up next week? I hope so, but I still don't know. Is it going to go up in a few weeks or a month's time or 3 months' time? Yes, most likely it is. And that's how you're going to take your position. So if it goes up tomorrow and you're able to take profit on your position, fantastic. If it doesn't, no problem at all. You can still continue trading. You can accumulate other positions and other currency pairs. Okay? So we utilize a trading grid to help us determine the value of the currency pair. The idea is to give price a context, to understand where the recent highs are, where the recent lows are, so that we can determine whether the current price is high or low. Taking this approach, we're able to benefit from the general volatility of the markets without the need to be super targeted with our entries. And we're able to remove timing from the equation, which allows us to make money in 2 of the 3 trading conditions. Does anybody know what they are? What are the two of the 3 trading conditions? We've got trending, we've got consolidation, we've got reversal. So we'll make money if the market's trending, we'll make the money if the market's consolidating, and we will mitigate our risk if the market is reversing. Now, the application of this is where you probably want to take a screenshot, okay? Because this is the stuff that you're going to go and take away and apply to your own charts. So the grid consists of 4 levels that create 3 price zones. The level should take into account key levels. So you look at your support and resistance areas, and they want to be approximately 4 times a daily ATR apart. The ATR is the average true range, okay? And I measure the average true range over a 20-day period. So what is the average high to low of a particular candle over the last 20 days? I'll take that value and then I'll multiply it by 4. And that will be my distance between my levels. So if I have a grid in the pound dollar, for example, and the ATR is 50 pips, well, we know that a screenshot isn't allowed. I'm not sure, Samuel. Maybe just write it down then. So if we, as I was saying, if we've got a daily ATR 50 pips, then I know between one level and the next level, it's going to be roughly 200 pips. So from the low to the high, it's going to be approximately 600 pips. It doesn't have to be bang on because we want to take into account the various highs and lows, but that's roughly what you're looking at. Now, the idea is to build positions in 2 of the 3 price zones and then unload them in the 3rd. So for example, if your directional bias is up, so you think the market is going to appreciate in value, you're going to want to buy positions in the first 2 zones. All right, remember we've got 3 zones here. So the first 2 zones, we want to be buying position. When we get into the 3rd zone, we want to be taking profits. And that's how we do it again and again and again until our directional bias changes, and then we use it, and then we go in the opposite direction. Okay? I'll give you guys my email after, and I can email you these slides if you like as well. Yeah, we'll come to an example in the minute, Bando, okay? The next part are the entry rules. Now, as I said before, entry rules give us an objective way of entering the market. Okay, they allow us to operate without emotions. However, it's not the biggest part of this. So from an entry rule perspective, I don't have the time here to go into all of that. So I'm going to leave that up to your imagination. You can go on to Forex Factory, whatever, find, the latest and greatest system and apply it with this grid trading system. I promise you won't be disappointed. Now, the last part of this is the trade management. So understanding what to do once you're in a trade is probably the most important aspect of our trading framework. We don't like to leave anything up to chance, and we like to be in a position where we can make money in more than one scenario. Okay, so with that in mind, we no longer look at individual trades, but rather we look at a portfolio of positions that allows us to express our view of the market. Okay, so a single currency pair can accumulate up to 3 separate positions. These positions, okay, now bear with me when I say this, will be carried without a physical stop loss. Okay, so essentially what you're going to do is you're going to use the grid as your stop loss, as opposed to saying, I'm going to have it underneath the latest swing high or swing low. Because you remember earlier, we need to stop ourselves from getting into a position where we need to be right away. No, we can be right in the long run. And as long as we're right in the long run, we will be able to make money. The idea is to benefit from the random volatility of the markets without having to be right on the short-term direction. We want to avoid situations where we're right on the direction, but we lose money due to our timing. All right. Now, this, as I said, this approach is something that completely changed our trading fortunes when we first started out, and it's continued to do that for our students as well. Now, some of you said that you want to take a look at how this looks on a chart. So that's exactly what I'm going to do now. Let me stop the sharing somehow. Let's bring up a chart you can take a look at. Okay, so this is TradingView. Okay, and this is the charts. Now I'm going to show you, I can show you some of this year, but let's go back to last year because we had a nice clear directional view there. This year, just in case you're wondering, it's been performing very, very well. There just hasn't been as many swings back, so it's not as evident what the benefit is because pretty much anybody could make money in this market over here. So let's go back to a slightly more challenging market when we had a few more swings. So this was last year, okay? The market was selling off. Please drop the email. Sorry, 1 minute. Yeah, I'll do that in a second. So if you let me finish doing this, then I will do that for you. Okay. Okay. So the ATR is at the bottom here. The ATR gives me the average true range. Okay. So if I look at this over here, you can see the ATR is like 50 points. So the average, sort of like the distance between them will be roughly 200 pips. But what I'm looking to do is I'm looking to encapsulate, if we go back to here, right, I'm looking to encapsulate the swing highs and the swing lows. Okay, that's what I want to do. So I want to be roughly where it is and also taking into account where the support and resistance levels are. Remember, the grid isn't necessarily to trade from, it's just to help you contextualize price. Does that make sense to everybody? ATR with a period of 20 days. Yes, absolutely. So what you do is we have a directional bias. Now, last year with the euro dollar, our directional bias for the majority of the year, okay, and that actually goes back before this, but for the majority of the year was to sell the markets. Why do we want to sell the markets? Well, there was an interest rate differential between the US and the Eurozone. The Federal Reserve were way ahead of everybody else in terms of hiking interest rates. Okay, they kind of foresaw the inflation problem, so that's where they were at. Europe, on the other hand, had the issues with the war in Ukraine to deal with, which are obviously going to cause issues with their economy. And they were a little bit later to the party in terms of their interest rate hikes. So we had a short bias in the euro last year. Now, what we would do is you would use your favorite trading technique to get involved in the market. So that could be, for example, you would put in this grid. That could then be, taking trend line breaks. You're looking to sell, things like that. And on the way down when the market is trending, it's easy, right? You could take a break of a support level. You could put in a moving average. So one of the things I like to do is trade a very short moving average, like a 10 or 20 period moving average. And when price is one side of it, then I'm very aggressive in my buying or selling. All right. But again, it's your favorite entry technique. Then this is where it really comes into its own. When the market trades against you, like this area over here, okay, we had a directional bias. This is where it's going to help. Our directional bias was to sell the markets. The markets sold off, but then it started to come back. Now, what do we have here? Well, we have a high, we have a low over here, and then we have the market break that high over here and start creating higher lows. So in ordinary circumstances, you would look at that and you'd be like, well, the market's changed. I therefore now need to start buying the market because the direction of the market is to the upside. Okay, I want to be a buyer, but actually you got your directional bias fundamentally, or if you're using a long period moving average, you can do that. You've also got the grid to provide context around your trade. And what you would say is, well, actually my directional bias is to the downside. Okay, the market is only in the second part of my grid. It's pulled back a little bit. So actually, I'm going to look at this, and this is going to be a selling opportunity for me because I love the idea of selling down here, but now it's back up here. I get an even better price. And here's the best part. Let's imagine that you sold down here. Remember, you don't carry a physical stop loss. Your mental stop loss is basically if the market breaks out of the high of the grid, or if you change your idea. So you say, oh, actually, I don't want to be short anymore. I want to be long. And then you manage your way out of it. Okay. But what you say here, so you've held a position from down here. The market comes up here. You maybe had another position on. So you've got one position down here. You got number two over there. Then when the market comes back for you, what happens is that you can take position, or you can take, or you can close this position at break even, and then you can close this position at a profit when it comes down to this entry level. And the great thing is it doesn't even need to come down to that entry level because as long as it travels half the distance between these two, between 1 and 2, you will still be able to close your trade for a net break even. So even when the market is going against you and you change your idea on which way you want to trade in, okay? So let's say, for example, when the market started to go against us over here, maybe we added a position in here. and then we would add another one. I don't have the grid here, but you'd roughly there, you'd add another one there. It comes down to there, you'd be able to come out at a profit. Or even if you came out here, you come out at break even. Now, let's say you didn't read the warning signs, which were clear, by the way, at this point in time. But let's say you didn't read it, and then you took another position here. You're like, oh, maybe it's breaking through that level. And then the market goes against you. It comes back and gives you another opportunity to sell. Again, you can come out either at the bottom there with a profit or in the middle there with break even. Okay? Does that make sense to everybody? You just use, to set the grid levels, you just use horizontal lines of support and resistance to identify the most obvious levels of support and resistance, and then you trade within it. See? And let me put my email address in here as well, just so you all have it. Are there any questions? You are most welcome, fam. Now, it takes a little bit of time to get your head around this. But I promise you, once you start to look at it and implement it into your trading, you will find that it is a massive benefit to you. I've actually got a video of this on YouTube as well. If you search me, Alex Ong, I'll put in here. So basically on YouTube, you'll see that I do have a video on grid trading where I go into this in a little bit more detail. So feel free to jump across there if after this, obviously come back and revisit this recording, absolutely. But if you need a bit more detail, then please feel free to jump across to there. How do you know? So that's, I mean, Samuel, in terms of knowing which currency pairs to trade with a good correct directional bias, that's going to come down to your ability, obviously, to analyze the markets. What I do is I look at the fundamentals. So I look for pairs where there's a clear divergence in the monetary policies between the different central banks, because that's generally going to pull the currency in a particular direction. But you could use moving averages, for example. Yeah, I generally trade this on a 4-hour or a daily time frame. Do I take entries on the lower time frame? You can do. I try to stick to the 4-hour time frame. Otherwise, you find that you end up trying to take too many entries. But you can do. But what you want to do is you just want to observe when the market is coming back towards like the support levels and you've got it in line with your directional bias. You look at these as opportunities. Like, okay, it's at the support. You don't need lots of extra confirmation. You just need the fact that it's at that level. And so, okay, I'm going to take a position here. And if it breaks through there, I'll look at the next support level and accumulate another position there. Does that make sense? Excellent. Thank you. Yes, Mohammed, we stack trades. That's the whole idea of this. You stack trades indeed. Go and take a look at my video on YouTube about this. I think it will give you a lot more sort of a better idea of this. And then what you can do, because obviously we don't have a lot of time here, you can then send me an email or something. We can pick this up offline. Okay. Well, if there are no other questions, you are most welcome, Mohammed. I'll thank everybody for joining today. I'm glad you all enjoyed it. Thank you to FX Street, as always, for putting on these webinars. If you haven't checked out their schedule, make sure you look at their schedule of live shows. They've got a bunch of these that take place every day. So yeah, take a look at that. Thank you so much for having me, and I will look forward to speaking to you all soon. Take care now and have a wonderful day.